Well, welcome to our High Rock monthly video and Happy New Year to everybody. Today we're going to take a look at what transpired in financial markets in 2018, and perhaps it was a bit unnerving for some, but certainly not completely out of the range of our expectations. But the impact on portfolios over the course of the year has ultimately been negative. I'm Scott Tomlinson, and I am joined by my colleague and partner, Paul Tepsich, and High Rock's certified financial planning professional, Bianca Tomlinson, is also on the call with us. Well, as you may all be aware of, we operate three investment models from which we are able to apportion an allocation percent to each client portfolio, depending specifically on their goals, the time horizon to achieve those goals, and their tolerance for the risk and potential for volatility that may be necessary to take for achieving those goals. In some of my conversations with clients recently, there have been some discussion as to why we have carried higher weightings in cash and cash equivalent assets than a more fully invested portfolio. And to a lesser degree, why we cannot go to 100% cash when we see difficult markets ahead. Well, our research, especially at the macroeconomic level, allows us to generate our expected outcomes for financial markets within the context of the data that we analyze and how it relates to what has happened in the past. Now, we certainly cannot predict the future and never would be so arrogant to suggest that we can, but we attach a probability to the outcomes of financial market events based on what we've experienced in the past. And that's our experience and our expertise of many years that allows us to do that. If we're 100% certain of how financial markets react to any particular circumstance, then and only then could we be fully 100% invested or 100% in cash. But that will not really ever be likely because there's always going to be some uncertainty. Given our current perspective, we've chosen to be cautious with our investing models, putting a 60 to 70% chance of significant economic slowing and or recession in the near future, but only a 5% chance of anything as severe as the financial crisis of 2008. Paul, you can agree or disagree with me on the 5%, but I certainly don't believe that we have anything in any high probability that we'll see financial issues to the degree that we saw them in 2007, 2008?
Well, I wouldn't disagree much, and I'm not sure if it's 5% or 10 or 15% chance of something like a 2008, 2009 credit crisis or the way markets behaved. But what I do know is if we did have some unknown event, and we can't really predict what these black swan type events will be, but if we did have one, what we do know today, Scott, is that the central banks know how to combat it and act very quickly. And we know the recipe for that now. So that's much more helpful than it was in 2007, 2008.
Sure. And actually, we'll talk a little bit about that as we go through the call today. But in a nutshell, going to 100% cash would, we think, generally in that context, be likely be an error in judgment at this juncture. But a 30% cash weighting, as we have maintained for the most part over the course of 2018 and before that slightly, becomes somewhat of a more reasonable call due to the unpredictability of markets. So 2018 had a great deal of these so-called market events, and although we had been expecting some late economic cycle volatility, I do not think anyone could have foreseen that what we witnessed over the course of the year, especially in the month of December. Paul, do you want to talk a little bit about fixed income? What we see on the screen here is just the Canadian Universal Bond ETF, which is XBB, part of what we use to benchmark ourselves as part of our portfolio comparisons.
Yeah, well, the bond market, right, that's a yearly chart, so it's probably kind of tough to see. Where you have the red arrow is 2018, and it was a tough year for the first 10 months of the year for the bond market. It was certainly a bit volatile, but generally, as you can see, the first 3 quarters of that red line in 2018, it was a down market, i.e., government yields were rising, corporate bond spreads were at their lows, so investment grade and high yield bond spreads were at their lows, which means they were arguably expensive. But it wasn't until the stock markets finally broke in October and right through November and December that, as you can see there, government bond yields, which are a huge part of the XBB ETF that we're looking at, actually saw what's called a flight to safety or a flight to quality, where investors rotated out of risky assets like equities and into government bonds. And as you can see, that price popped up pretty sharply over the last 2 months of the year. And as it shows, ended the year with a marginally positive total return. And again, XBB has government bonds, investment grade bonds, high yield, well, very small amount of high yield bonds, mortgage-backed bonds, provincial bonds, et cetera. So it is an entire universe of bonds, largely higher rated bonds that folks would gravitate to in times of duress, like we've seen over the last couple of months.
All right, thank you. As far as our global equity model, again, we use the All Country World Index as our key benchmark, but you can see that I've got a number of things up there. We also use the S&P TSX too, because we do have exposure to Canadian equity markets as well. But just to give you an idea, you can see over the course of the year, the total return for these three, the S&P 500, the All Country World Index, and the S&P TSX, were all in negative territory.
And Scott, maybe you could even just highlight here on this chart and the previous chart, but you know, U.S. stocks wasn't an absolutely brutal year, but they were at their peaks, their peak prices as early as early October 2018. But those months of October, November, and December, you know, the Dow, for instance, provided its worst month of December since 1931. That's how bad it was. It was the worst Christmas Eve day ever. I think it was down, 1,000 points or something on the Dow. And then followed by December 26th being its best single day advance ever. I think that was up 1,000 points. So that was, and in general on the year, it was the worst year it's put in since 2008. So although, you know, on a year annual basis for 2018, it doesn't look brutal with the Dow down about 6, the S&P down about 6. Doesn't look absolutely brutal, but boy, it sure was bad in that last quarter of the year.
And just as well, I mean, we've had about a 50% underweight in our equity model. So we're 50% underinvested in equities in the global equity model. And that's actually taken a lot of pressure off of client portfolios. And it may not be as apparent, especially because of what you were saying, Paul. A lot of that pressure came in the end of the last quarter and the last month of 2018.
Yeah, well, we're better lucky than smart, I guess. But it was certainly helpful being underweight equities.
Well, sometimes we're lucky, but here's where we actually have been a little bit smart. And we've talked about this before. You know, back after the financial crisis, the U.S. Federal Reserve undertook a period of quantitative easing, otherwise known as QE to a lot of people, where they were adding liquidity to the financial system and letting the monetary base grow until they started to reduce their balance sheets in 2016 in what we can classify as a period of quantitative tightening. Now, it certainly hasn't been as aggressive tightening as it was easing, but the combination of the quantitative tightening and higher interest rates from the U.S. Federal Reserve have lowered the monetary base, and it's taken equity markets in the U.S. to some time to actually realize that the liquidity factor is drying up, and certainly that explains the volatility that we've got over through most of 2018. Is that stocks were trying to go up as liquidity was being drained from the system. And Paul, you and I have talked about this on a number of occasions in the past to our client base, but this is certainly one of the reasons that we've been relatively light in our global equity model.
And Scott, also what that chart doesn't show is the U.S. dollar is appreciated fairly substantially over that period of time as well, and that produces a tightening mechanism in the U.S. system, and that continues to this day.
Yeah, exactly. In just a second, I'll pop up a slide of the U.S. dollar against the Canadian dollar, and we'll have a chat about that. But one of the things that we have talked about also in the past is that we've got money to put to work, but we certainly want to put that money to work when stocks are less expensive, when there's better value. And you can see, and we've talked about the cycle, the economic cycle, but the time to put money to work is usually, or has been, at the beginning of the new economic cycle. So in time and through the course of 2019, we'll probably move from the old economic cycles through some slower economic growth, as we've suggested, and into the next economic cycle, which hopefully will give us some opportunities, some good buying opportunities, and be able to put some of that cash back to work in equity markets. And there's the US dollar, Canadian dollar, Paul. Maybe you'd like to say something about that.
Yeah, well, there, as I said recently, certainly. Well, this chart's actually pretty interesting, and one of the key drivers, I think, on the Canadian dollar over the last number of years has been, like it or not, has been a federal political situation where the Liberals got in power in 2015 and have been running and look to be, if they get elected again, will be running massive deficits for as far out as the eye can see. Capital markets, global capital markets typically do not like that, and it is being reflected in the currency. The other problem we've got with the Canadian dollar has been on the energy side and what's called egress or transportation issues, which everybody's probably well aware of now. The lack of pipelines to carry our heavy oil out of the country to higher price markets, including the U.S. That has been an issue on the Canadian dollar. And then, of course, the U.S. dollar itself, as I mentioned a few minutes ago, because the Federal Reserve has been probably the only central bank that's hiking rates in such a way that it's strengthening the U.S. dollar against just about every currency around the world, including the Canadian dollar. Now, also, when you go through periods of, let's call it risk off, like we have the past couple of months and may in the future, the U.S. dollar typically gravitates, investors rotate out of riskier or even commodity-based currencies like the Canadian dollar, like the Australian dollar, and into the U.S. greenback for safety. So that's certainly what we've seen over the past, just even over the past couple of months, where we popped up from 130, as you can see, U.S. dollar Canada terms, up to 136.5. Now we've rallied. This Canadian dollar has strengthened rather dramatically over the past week or so. Well, really just a week, very dramatically. And I think some of that just on the fact that we have had some legislation in Alberta to help out with the heavy oil situation, where the province of Alberta has restricted about 300,000 barrels a day from large producers. And that is having an effect, without doubt, on the price of Canadian heavy oil that's gone from $15 a barrel U.S. to almost $41 a barrel U.S. today. So very dramatic move in that commodity. So that's starting to be reflected in a stronger Canadian dollar today. That's it.
Thank you. All of our clients will receive this table that you see in front of you in their year-end portfolio summaries. But I thought I'd just quickly walk through this. The reason that we put this out is we take our benchmarks and we look at a typical, say, 60-40 portfolio, which uses about 50% of our global equity model, 40% of our fixed income model, and about 10% of our tactical model. We estimate that a good benchmark comparison portfolio would be invested in about 25% global equity, 25% Canadian equity, and 50% fixed income because of the current structure of our models. And this is just a comparison as to how that combination looks when you use the benchmark. So you can make comparisons as to the performance of your portfolio over 1, 2, 3, and 5 years to just see how it compares relative to the benchmarks. And you've seen this before. This is a 5-year High Rock client portfolio. And what this is trying to show, not only is it showing the performance of some other benchmarks. At the top, you can see the table with the S&P 500, the S&P TSX, the Canadian Bond XBB, the All Country World Index, and then that combination 60-40. But you can also see the risk that is associated with having those indices and the relative risk for our High Rock private clients, which in most cases is significantly lower. It does give our High Rock clients a return per unit of risk taken well above all of those other benchmark indices. The key is that we're trying to get our portfolios into that optimal quadrant that we call the Northeast quadrant on that chart in front of you. It's been a little tricky over the last year, obviously, with what's going on, but we're still doing it better than all of those other indices that you see there. So not perfect. We'd certainly like to see our returns higher. We expect that they will. We expect that there is a good chance we can get back to better returns as we move into the next phase of the economic cycle when we get there. But we do have to be a bit patient as we go forward.
And Scott, just to highlight as well that actual High Rock private client, the return you see compounded annual total return over that 5-year period is after the fees that client has paid. So all of those indices, the S&P 500, the TSX, et cetera, they don't have any fees embedded on them. They're indices. This client has already paid fees on top. So if you added their fees back, that household's fees, it would even look a hell of a lot better and more competitive to those other indices.
Exactly. All right. We've been working quite diligently on producing our client reports. They should be coming to you very shortly. And as a result, we also have been trying to make sure that everybody's been notified as a group as to what the increase is in the TFSA for this year. You're allowed to put in $6,000. So if you haven't yet had a conversation with Bianca about that, certainly it may be the right time to do that. Bianca also wanted me to remind everybody that the RSP deadline was going to be March 1st. And if you are wondering if you should be contributing to your RSP, certainly that is a call that we want you to have with us. And usually it is a function of your wealth forecast and what your retirement goals are and what your current tax situation is. So that's something that we're happy to address on an individual basis. And of course, any questions about your portfolio, please feel free to get in touch with us. We definitely want to make sure that we're continuing to have communication. So we would really like you to get in touch with any of us as far as that's concerned. Anyway, that's it for this month. We will certainly be back next month. But on behalf of Paul and Bianca, I want to wish everybody a happy New Year, and we'll, as I said, be back at the beginning of February with another edition of the monthly webinar.